Hello, this is Patrick. Welcome to Chart Built Wealth, profitable investing with technical analysis. I wanted to make a bearish recommendation on the U.S. stock market. As subscribers and viewers over the past 7, 8 months, I've referenced some of the negative long-term divergences that I was seeing on the S&P 500, but I've never actually shorted the S&P 500 or suggest a bearish stance, but I am this evening, uh, even while I've been bullish on utilities and REITs and consumer staple stocks. For those of you that have watched my YouTube channel, gold miners, etc. Uh, but I did want to make this call, and I think those things will still work. I think that they're going to be more stable than the overall market if I'm right on this. So let's get into it. Okay, so we're gonna usually I start long-term with long-term charts because they're more relevant and work my way back to shorter term charts. But tonight, this call on while all the long-term things that I see that are bearish may come to fruition, the only thing that we know is what's going to happen tomorrow and the next few days. So I wanted to start with my short-term bearish call on the S&P 500, and then I'll give you a couple of other things to think about. So this is the daily chart of the S&P 500, and it only goes back about 4 months. So each one of these bars represents a day of price action. And what I wanted to highlight here and why I'm making this call is because on a short-term basis, we have a pretty good setup here. Not for an ultra multi-year decline or an 80% decline, but I think we can make some money on this, and maybe a good way for you to hedge some of your outstanding equities that you currently have. So uh, here is a confluence of moving averages that are all coming together, and you can see that prices broke below that. And you can see the last 2 days we've had a retracement back to that convergence. And according to Tom McClellan, a colleague uh, and a who created this indicator, I want to give a shout out to Tom. This is called a type 2 rainbow convergence. And the suggestion here is that when prices come up to the confluence of moving averages, if it can't break through, it promises a new low. So how much lower than 5,400? We don't know that. I don't think it, based on this chart, it's going to be a hugely significant decline, but that is only on the daily chart. But the setup tonight is very good for a decline over the next several days. So let's go from a 4 month chart to a 3 year chart and see what we got going on an intermediate term basis. So here we go. Each one of these bars represents a week of price action. And here's our bullish channel, the two horizontal upward sloping blue trend lines. And you can see over the last couple of months, the market looks a little overzealous in that it's challenging the resistance line and having slight breaks and then falling under. This is an overbought market. So does that mean it has to go down tomorrow? No, but it's just making a statement that it's overbought and that, I wouldn't be a huge buyer with the S&P at this at this juncture. But what I did want to point out is all these last two highs and a third time that we retested the high on our relative strength index, we've had lower highs. And that's what I term, or what technicians term, a negative divergence. And while they can get rectified, it flashes a caution sign. Beware change of trend is coming, and in this case, it would be from up to down. And on an intermediate term basis, prices could fall back to its support line, back down to 4,800 or so. So that's what we got on an intermediate term setup. And now we're going to go to the long-term chart. So the long-term chart goes back to 1997. I hope you were alive back then. I was, and I remember this very well. So let's take a look at the long-term chart of the S&P 500. And here we are. And so each one of these little bars is representing a month of price action. And so you can see that starting in 1997, as all these prices hit higher highs, our relative strength index was hitting lower highs. It's like the general's running up the hill to engage in battle, and he looks back and his troops are behind him on this first peak. On the second peak, there's less soldiers behind him, and on the third peak, there's hardly any soldiers behind him, and that sort of thing. So this was a 1, 2, 3 year negative divergence, and it meant something. So when it happened, the decline went from 1,500 to 768. So, I don't know, you lost half your money basically. In 2007, we had a much smaller negative divergence. I think it was only 11 months. But look where we're at now. So, the last 8 months, I pointed this out and I just said, this is something to keep in the back of your mind. No, I'm still going to buy utilities. I'm still going to buy REITs. I'm still going to buy gold miners, etc. But this is in the back of my mind. So we now have a 1, 2, 3, 4, 5, 6 year negative divergence. And as prices hit all these higher highs, so can this be rectified? Of course it can. But this is suggesting a much bigger correction. And so I just wanted to point that out. So as of today, I am bearish on the S&P 500, and my stop up above where we are is 45.50, about 100 points higher than where we're at. So if the market is able to close above 45.50, I get out and take my 1% loss since I'm shorting the market. I'm shorting the S&P 500. I still own my utilities. I still own my REITs. I still own my gold miners, etc. But I'm also going to be short the S&P 500. If I can make money on 10% of my portfolio by being short the S&P, it'll be a great thing, right? So that's where we're at. I hope it makes sense to you. Thank you for watching Chart Built Wealth, Profitable Investing with Technical Analysis. Please like and subscribe. Some of these are also intraday updates, which are actionable and give you a jump start on your competition. So thank you. Have a great day tomorrow, and adios.